trying to tell me that things are working a different way. No, it's not. It's simply to say, no, it is not. Every time you hear this time is different, it is not when it comes to the economy. So things are definitely slowing. The housing affordability is below we saw into the financial crisis. It's below what we had in the 1990s. It's actually down to what we had in what we call the poor age. Just if the Fed was in charge of the moon landing, they would miss the moon completely and just continue to Mars or something. If you look outside of the Fed, is that they have realized how bad this is. So if you look to the ECB, they are, I think, 9 or 10 cuts ahead of the Fed at this point.
Henrik Zeberg is a Danish macroeconomist with decades of experience studying business cycles and financial markets, a specialist in macro cycles, Elliott wave theory, and asset analysis.
He is renowned for bold calls on crypto, gold, and other assets. Though still bullish in the near term, Zeberg warns that a recession is on the horizon.
At the point when the Fed comes out, boom, a 50 basis point cut, and we see the market going straight up. And then everybody will be pulled in and say, now the Fed has got our back. In the longer time frame, I would be very, very cautious of altcoins and even Bitcoin. I have to say that the crypto is I said it before, I'll say it again, crypto is the very definition of this bubble.
Hey guys, welcome back to Less Noise, More Signal. Today I have Henrik Zeberg with me. Very cool to have you on the show, Henrik.
Thank you so much for having me on today.
Yes, it's great. Yeah, you were popping up on my X account every now and then for the last few weeks. And whenever I see somebody continuously popping up, I want to pay attention. And obviously you have some really spicy and interesting takes. And it just so coincided that I was also looking at a company I think that you were sort of affiliate or are you affiliated with, Swiss Block. And so it's really good timing to be talking to you. But if you could quickly introduce yourself, who you are, where you're coming from, and where you, what you work, what your daily work is, that would be great.
Well, so I'm the head macroeconomist at Swiss Block. I have a master's in economics from the University of Copenhagen from the year 2000. For many years, I didn't work within economics or within finance. I was a consultant doing due diligences for businesses, trying to do acquisitions and the likes. And then after 2008, the world kind of collapsed, the financial world at the brink of collapsing at least. And it was a time where, at least after I look back and having gone through some troubles there also myself, having to say, well, how could it be that people didn't really see this coming? And those who did, why didn't we pay more attention to that? And then I started to dive in. And when I dive in for real. So I kept doing that. And I was just, surprised to see that the signs were there. The signs were there that something, really severe was coming at that point. But nobody really just, paid attention or kind of shoved it away and said, hey, we are a little more positive than that. Or we think this time will be different. And, so people didn't really, engage themselves with the idea of that, well, this can actually become something of a severe crisis. And we know also that the Fed and Bernanke was out there in February of 2008 saying, hey, if a recession is coming, we will be ready. So I saw all of that and I just thought, how can that be? I mean, if the Fed was in charge of the moon landing, they would miss the moon completely and just, continue to Mars or something. It's so bad. I mean, it's really so bad. If you were a mechanic and you had to repair the car, I mean, the car would still be broken down when you got it, or even maybe in a worse state because it's so bad. I mean, the guidance on things. And that's where and again, also when you lend it to various banks, also sometimes you'll have some there sitting there and trying to get you their clients into various investments. And you need to have that sound and healthy, sober outlook on things. So I dived in and then I got, I have had some services over the years. And then I'm working with Swiss Block on, as I said, as the head macroeconomist. And what I do is that I help our clients understand the macroeconomic environment. I try to use my business cycle model that I have developed, which simply gives us the good, long structural understanding of where the economy is heading. Because unlike what you see in media and everywhere is that I don't see the world as, one week we were talking about a recession and the next week we were talking about, now we have a booming market, or just 2 months later, like, BlackRock coming out in April say, oh, maybe the recession is here. And then 2 months later, oh, now we're just, all-time highs and we can just keep going. That's not how the things are working. I mean, the economy is 8 billion large, species consisting of a lot of people buying, selling on a daily basis. And it doesn't change direction just overnight. So this is what the business cycle is capturing. Really, how does this super tanker, which it is, the global economy, how does it work? And there are simply, things that it's quite simple, actually. Honestly, it's more simple than most people will think. And I think sometimes that it seems like the financial world is deliberately making it more difficult, or it's because if they make it more difficult, then there's more need for them. It's really about the consumer. It's about the labor market. It's about the housing market. And then it's about understanding which indicators are starting to move when. And if you know that, then you can pretty much understand economics.
What if you could lower your tax bill and stack Bitcoin at the same time? Well, by mining Bitcoin with Blockware, you can. New tax guidelines from the Big Beautiful Bill allow American miners to write off 100% of the cost of their mining hardware in a single tax year. That's right, a 100% write-off. If you have $100,000 in capital gains or income, you can purchase $100,000 worth of miners and offset it entirely. Blockware's mining as a service solution enables you to start mining Bitcoin right now without lifting a finger. Blockware handles everything from securing the miners to sourcing low-cost power to configuring the mining pool. They do it all. You get to stack Bitcoin at a discount every single day, while also saving big time when tax season hits. Get started today by going to mining.blockwaresolutions.com/LNMS. Again, that's mining.blockwaresolutions.com/LNMS. Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Yes, very interesting. Well, I mean, that's a great way to segue into this discussion. Like, you've been vocal about the fact that there might be another recession coming, and I just want to bring this up because I was talking to Michael Howell just recently, another macro guy that people are familiar with, and he was also mentioning we are sort of late stage cycle, in the cycle that he's looking at. So from there, I feel like there might be some consistency there. Then at the same time, I was talking to other people, who were still a little more bullish, longer term even. And obviously, it's all about time frames. That's the thing. Sometimes people talk past each other because they're looking at different time frames. But from you, I would still love to know. You had this sentence where I read on X where you said, what leading indicators have flashed since November 2024 that are sort of showing that a slowdown is coming. Could you elaborate on exactly what you've been looking at and what these indicators are, sort of?
So the leading indicators are something. It's not just something I have come up with. It's something that the conference board, you can go look at that. Is actually that's their framework pretty much. I just use them in what is a more structural manner. And when the economy is starting, I mean, as I said before, it's a super tanker and it moves up and moves down and moves up and it moves down. And when it starts to move in a certain direction, there's a certain momentum to things. That does not mean then that all of a sudden when something hits the, that something makes a change to the economy, that then all of a sudden we fall in a recession. That's not how things are working. Things are working in a way where you'll start to see some impact, which then will cause the direction of the economy to shift in a slow manner. And this is what people need to understand. That's where everybody is so impatient that if it doesn't happen within the next few days here, then or next month or next half a year, then things are not developed. What we saw in actually after COVID was that the economy was in a new boom after that. They infused so much money, so much stimulus that we got a new bull cycle. So when everybody in 22 was saying, oh, now we're in a recession, my business cycle, my indicators, my leading indicator was actually still rising. And it was the simplest call to say, there's no way we're heading into a recession, even though markets were down 20%. And everybody was out there saying, okay, now we fall back into the abyss. I said that back then. I said it again in 23 when we had a banking situation also may not remember, there was kind of a banking situation also in the US. And then we had also here in even during also when Bitcoin was dropping a lot in 24 and also in 25 here when we saw the April decline. All of these things are something that you can dismiss by looking at the leading indicators and the constant indicators. But the thing is, as you asked, well, how does it work? The leading indicators are actually something like the yield spread. When the yield spread inverts, it's one of them. It's not all of them. It's an index. So it's an index that I'm using, not just one or two. When you see that happening, then it's actually a sign to us, to everybody, that things are now not good any longer. There's something happening to the economy. We got the blow. Famously, you can say that you're hitting the iceberg. It doesn't happen again. Even the leading indicators are somewhat sluggish, and they need to see a certain deterioration to them before we actually get that crossover. So what we have seen in the model is now, which is mimicking or mirroring what the supertanker is doing, kind of to see that when they turn into the bad scenario, into the bad environment, they cross over my equilibrium line. If you look back in time, you'll see that the 70 years back, I got data. Every time it has done that on a quarterly basis, you will have a recession coming. It's not there immediately, but it will be coming. It means simply, as I call it, the Titanic moment. Titanic is going to sink. It doesn't mean you cannot have another drink. It doesn't mean that you cannot have, people will not, don't believe in it, but it's actually taking in water and quite rapidly. And we got that, if you look at my business cycle, for instance, also in November of 2006. Nobody really understood that there was anything wrong with the economy going into 2007 and all the way up to the stock market top in October. Really, people didn't think of, that there could be any problems. Even the Fed was out in September of 2007 saying, we are actually concerned about inflation. The stock market is still actually, the labor market is still strong. And I think actually it was in October 2007. That was a point where the quarterly growth was already declining at minus 1.6%, which means that they were completely off chart. I mean, they had no idea of what was going on. They didn't see the Titanic sinking, even though the iceberg was, just next to us. But that's the way it is. Then now we've seen that same moment. We saw that in 2024 in November, that the leading indicators have simply just crossed over, and strongly so, to a degree where I say, okay, now things are starting to deteriorate. And I've said that throughout 25, and people are saying, yeah, Henrik, but the labor market is so strong. And you have heard that consistently from the Fed as well until Friday. Then it comes out, oh, by the way, the numbers we gave you in May, we have to take those down by 100 and some thousand, down to 19,000, which is the same as zero. It can easily be a negative number by the end of it. Oh, by the way, June was not something else. I don't remember how much they had to 133,000. I think it took down by. It's actually only 14 or 19 or 14,000. And then July, we say it's 73. But let's see about that 73. So what you have now is that what the leading indicators have been telling us, that there should be a slowdown and that should lead to a recession, is now not so unlikely any longer, because we actually already had very bad numbers. And if you take the GDP number we got last week, which was a 3%, and look at that, and then to simply dissect it and say, wait, hang on, how can we have a 3% growth, but we see that the job market is only creating 19,000 jobs in, say, in June? Well, it's because the GDP numbers are actually also affected by what we saw in Q1, which were the tariffs, where you saw that a lot of investment were front-run, and that meant that simply not net exports actually also were skewed, and that gave us a wrong number there. And more likely, we have had a 1% growth in Q1 and a 1.5% growth in Q2, which is significantly lower than what we saw in 24. So things are definitely slowing. If you look at the continuing jobless claims and so on, things that are telling us how easy is it for people to find a job after they lose their jobs, they have been moving up slowly. If you compare to previous, cycles, you'll see that when they reach a certain level, they just pop. And that's why I'm saying the leading indicators have been telling us this. And now we're starting to see that deterioration. And this is the moment where people start to say, hold on, maybe things are not as great as we were told they were. The Titanic may actually sink.
Yes, interesting. And are we now already talking about these coincident indicators as well, or are they coming on top, or what type of indicators are this? Can you maybe elaborate on this as well? Just so we understand how they match up with the leading indicators that you were just talking about.
Some of the leading indicators are, as I said, the yield spreads. And the yield spreads are simply, they were inverted, and people saying, okay, now you see the recession people saying that in 22, 23, but actually that's not how it works. And normally you would see that there would be a long lag from actually the point when they invert, and then until the moment also then when they uninvert, meaning that they actually move back up again, and you will see that the long-term yields are higher than the short-term yields. Wasn't the case back in 22 and 23, and people thought, okay, now we talk about that. It was in the media, and this is the indicator of recession, and then people forgot about it again. But actually, the problem was that these were actually it was the worst inversion we have ever seen, much worse than into the financial crisis, much worse than into 1929. And then people are just forgetting about it, not understanding that it's actually a very severe impact. We have with the iceberg there. That's one of the things. The housing market is another thing, in general. If you look at the housing market, look at the housing permits, it's down a lot. And you can just check that chart and see how they also, every time you get a decline like what we have seen, you will get a recession. Not immediately, but at some point. And we saw something similar into the financial crisis. Housing market is actually a very important point. I said earlier that it's about the housing market, it's about the labor market. And we know it from yourself and me, if our house starts to depreciate in value, you'll think, okay, I don't feel as rich as I did, before, but I'll stay with my house and, I'll just pay my bills and so on. But if you also lose your job, then you start to have a problem, because then you probably won't be able to pay your bills. And then the value of your house becomes even more important, because if you have to sell it or refinance it or something, well, then it's a problem. So it's actually the thing we see in the housing market that has been telling us for quite some time. The housing market is really bad. And if you look at the sales of existing homes right now, it is down at levels where, the US economy population were 70 million people fewer than we are today, or they are today. So it's a really big blow to that. And nobody really speaks of that. The housing affordability is below we saw into the financial crisis. It's below what we had in the 1990s. It's actually down to what we had in what we call the poor 80s, because people simply can't afford, taking on a new loan or actually refinancing a loan. It is all of that. That is slowly impacting the economy. That is some of the leading indicators. The coincident indicators, they're actually meaning that they are moving in tandem or in alignment with the GDP numbers. And those are the ones like production levels, and employment, and so on and so forth. And that's why when you see the impact in the leading, then you'll have to start looking at how does that then impact into what is the coincident. And then the lagging indicators are the ones which the Fed is following some of it, but it's inflation rate. Inflation is something that comes down. You can take a look at it, and it's so clear that if you look at when recessions are and what inflation does, it moves up into the inflation and then it comes crashing down. So if you sit there and you control your Fed policy by looking at the lagging indicators like inflation, that's like looking out the rear window while you're driving in traffic. And if you have to stop for the red light, you'll be passing right by because you won't see it before you get into your rear window. That is what we're looking at right now. So things are deteriorating leading indicators. Coincident are now starting to show inflation and yield levels will be coming down very, very strongly.
Yes, I see. Okay. Very interesting. I mean, obviously, these are numbers or facts that are out there. I mean, at the same time, I would like to hand over some counter arguments to you that I often hear, by people looking at these same numbers. For example, the unemployment numbers. What I've been hearing is like that we've seen structural shifts there underway. The retirement of boomers, the rise of AI, this lower immigration rate in the US, and they sort of arguing this makes it all more complicated to sort of look at these absolute and relative measures of employment. Or they're arguing, for example, that while we hit sentiment like the truly generational low in April and May because of the whole Trump situation, the fact that unemployment growth still remained positive, although it maybe came down a little bit, is the real signal that the economy is still resilient. And so I would be curious to hear from you. What are your thoughts there? Like, how do you counteract such arguments?
It sounds more or less like if I had to explain to a mechanic how the engine of a car works. I would have all sorts of ideas of why the car would still be working and why it should be able to drive and being, not having any troubles or problems. It's all over the place. I would be all over the place. I wouldn't know what anything would be called or anything. I would just, be trying to explain, something that apparently seemed to work. The problem with that is simply it's such a diverse kind of argument. If you're talking about that the economy is still strong, I mean what is strong is that the housing market. The housing market is not strong. The labor market just showed us that it was not strong. So I mean, and you can see if you look at, as I said, also the continuing jobless claims on the jobless market. They have been moving up slowly, but as starting to move into an area where they could actually rise more quickly. I mean, you will always have people that think that things are great and just trying to discard it. That's what we saw into the financial crisis as well. We had all the same the indicators that were flashing right now. We have them flashing right here. In fact, they're worse. You had the largest bubble in the world. I mean, people will talk to you like that and say, okay, so the largest bubble in the world, that will just continue to grow because there's, it'll never gonna pop. We have the largest bubble in the world. There's no denying of that. We have the market capitalization to GDP, and then you'll say, it's 213% right now. It was been, 105 in 2007. It has been 136 in 2000 when we had the ridiculous bubble of the .com. And then people still looking at it right now and just saying, yeah, we don't think so. It's different. It's the AI has done there's a difference there now. I mean, try look at what we said in 2000. It was the same thing. It's a new economy. It's not really about how much money we earn anymore, and so on and so forth. All these things are just, as I said, disperse kind of arguments, data points from here and there, not really understanding how the engine works. And the engine works like, if there's a slowdown in the housing market and it starts to spill into the labor market, then you will see that the economy slows. And that will show in the various indicators. And when the one rolls over, the next one will come. And it's shown that for 70 years. So I have to say, all of these talks there, I mean, it's like me talking about a car engine.
Yes, I see. I see your point. Obviously, maybe just to push back a little bit and play devil's advocate here a little further. I mean, one thing that I could also hear people say is like, for example, what if the engine just works differently today? With a car engine, we know obviously it has always worked the same, but maybe an economy, the real world is sort of more complicated. And in that sense, things that have driven the economy maybe 30 to 40 years ago, like the housing market and stuff, might not be that important anymore to the overall economy today. One argument I hear people make nowadays a lot is like government deficits, this fiscal dominance talk everyone is talking about. This is what's driving the economy. It's not private bank lending anymore. The marginal dollar is driven by physical deficits, and so this is why it's maybe different. The engine, it works differently.
And this time is different, is what we hear every time these things happening, right? If this time is different and you don't understand that now now we have all these things that you mentioned here, and that's why things, and this is just, this is the noise. I can understand that is why people, when they look at an economist and say, okay, wow, interesting, because we are all over the place apparently. We don't understand how the things are working. It's like looking at the weatherman. He says, well, maybe it's going to rain tomorrow, maybe it's going to snow, or maybe it's going to be sun, the sun is going to shine. We'll have to see tomorrow because we don't really know. Actually, we do know. Because if you look at the cycles, how they work, this is how it's been showing for 70 years in this. And trying to tell me that things are working a different way, no, it's not. It's simply to say, no, it is not. Every time you hear this time is different, it is not when it comes to the economy. And that's why I don't see it like that. And people will have to see it again, then that's fine. And in 30 years, when we stand with the next bubble, people will again say, but this time is different. I mean, guess what? They said that also in the 90s when we had the bubble there. They said, this is different. I mean, we have, now automobiles. Have you heard about automobiles? Have you heard about electricity? I mean, electricity is going to change the world. All of these things are correct. They're going to change the world. Everything we see now is going to change the world. But by the end of the day, you and I, as human beings, the psychology of, how we act is the same. And that is what's driving the world. And we will take on, a bubble can go on for longer, but it's still a bubble and it's going to burst. And there will be some signs that it's starting to burst. And those signs are there. And then you can neglect that or discard that and say, well, it's not happening this time. And I'll just say, okay, let's sit and wait and see that.
Yes, no, for sure. And that's definitely a case there or a point there, like human beings, the psychology in and of itself, it might be a little different this time, but at the same time, history always rhymes, and that's what we've been seeing consistently, just because human herd behavior is sort of the same. And the question that I would lead into is now like, is this the end of the everything bubble, that so many people have been talking to? Is that the cycle that we're talking about? Or Or I see you, another post that you had, you think that the winter is still coming, obviously, also for digital assets, and it will be very cold and long lasting. Opposed to somebody like Michael Saylor, who says there will never be a winter again. Institutions are now here, it's different. Maybe you have some thoughts there to share as well. Why
Yeah,
will it
sure.
be so long, particularly? That would be interesting. Yeah.
Well, because we're coming to what could have been a normal end of a business cycle. The business cycle is there, and it's simply it's impossible to have an economy working without the upturns and downturns and upturns and downturns. That's the way it works. And I take it too far to stop to explain why, but that's the way it has been working for many, many years. And when you have a downturn, there's going to be a recession. For some reason, we every time we get a downturn, especially when our long-term growth rate have been declining for quite some time, because the technologies that we implemented years ago are now starting to, there's always a good return at the beginning of it, but then it starts to be less and less. And we need a new technology infusion, so to speak. And we're getting that. I'm with you on that with the AI. But what we see the central banks try to do is that they are saying, oh, we can cushion that. We can make sure we don't get a recession, or we will make sure that, at least they'll be shallow. And then they start to print money. And this is not the first time we've done this. I mean, there was a situation before the financial revolution in France also. I mean, they were called the Arsenal, and they were, printed in abundance. And still you had a very bad crisis, and you had actually crises which were, the people were actually revolting at that point. What you see now is we've done the same thing in 2008. People, the central banks came out and said, oh, we'll make sure that the financial world doesn't, collapse, and then we throw in a lot of money to that. You can do that in a deflationary environment for as long as you have deflationary pressures on, which means that inflation is actually moving lower and lower for the long time frame. And you can just take a look at that, how that actually been seeing for the last 100 years. You have inflation going up and down, up and down. And for the 20 years, 30 years, it's moving down. It's possible for the central banks actually to use some of these stimulus measures. And we actually used that in 2008, came out massively, just throwing a lot of money into this. And then we sailed along for some time. And what happened then? Everybody took on extra debt, because when you put in a lot of liquidity, you push down the yield levels. And the yield levels means that I can actually afford to sit in a more expensive house than if the yield was a little higher. The same goes with car loans and so on and so forth. So we brought out a lot of, and we pulled forward a lot of consumption. That is what we do by that. See, that can go on for such a long time. But at some point, you can't push the yields any lower. And then they'll start to move up. And guess what? Into Corona, they came out and they said, oh, we need to stop this. And then they did the absolute, extreme mistake where they started to stimulate, to a very big degree, the economy into a supply crisis. And if you go on the first year of, economic studies or, university, you'll see that there's something called demand and supply. And if you push out demand at the point where supply is pushing lower, then you'll actually see that the price is going up. That is what we got. So we saw that situation. And at some point, you and I start to think, hey, we haven't seen inflation before. Now it was up at 9%, and people start to get that into their backbone. That is why inflation now is more sticky. Now, guess what is going to happen is the Fed comes out one more time next time and start to push, the QE bottom. I think that what we're going to see, and that's also what the chart is suggesting, is that we moved into a new inflationary situation, which means that inflation is actually now going to take off from here and going much higher. I got a chart that I've shared also on X many times. It's so clear. We moved into what is called a new inflationary regime. So the Fed, the free lunch of the Fed from 2008 and from whenever they did it also after that, is now over. Because the moment they start to do this again, you're going to see that inflation is going to move up. What happens if inflation moves up and they do this? Well, then everything you do is going to actually hurt the consumer even more, and they're going to spend less. So you are in a situation now where you have been pushing down in yields so much, and valuations up to the levels that we talked about, the largest bubble ever. It is by the largest, even if the market crashed to half the size today, it's still bigger than what we had in 2007. This is a massive bubble. And then we're thinking, oh, but that's all fine because, the Fed will have this under control. Guess what? Their hands are starting to get tied up, and they can't do much because if they do, inflation is going to hit. And that is going to hit the economy. So it is a different scenario we're looking into than what we had in 2008. This is different. I mean, that is different. And that's why the thing is that everything will be working out, like the business cycle is saying that we go up and through it like that. But this time, the response that the Fed can come out with is different from what we have seen previously. And that's why I think that they're going to try it. They're going to bring out inflation and maybe even stagflation, if I'm right in that we first get the decline. And I think that is going to be the longer term crisis we're going to see. So you have all the components are there, and you have the shift in the inflationary regime, which is going to make this worse, because everybody in the 70s knew that if you just went out and stimulated like what you did, what we have seen the last 17, 20 years, then you would have had a lot of inflation in the 70s. We forgot about that. But the thing is, when you get into that regime, that is what's going to happen. So you cannot do the same that we've seen. And people need to recalibrate their brains in terms of what is possible here. The Fed is not in control of things here. And obviously they don't even understand what's going on. So this is a long explanation. Things are different in terms of what the Fed can do because of the new inflationary regime. But the business cycle is still turning down.
And how are you now going to play this, believing that this will be the case? Because I think you said it yourself offline when we were talking, you're not yet super bearish, in terms of like asset prices. It feels like the top is not in, at least that's what I'm getting when I see your things. And then what is your model sort of predicting or printing any upcoming future high for risk assets? When could it potentially hit? Is this end of year or even extending into next year? How do you play this? Because I feel like at some point you will probably want to take chips off the table if you are still invested, because then, if you expect this longer lasting winter, you don't want to be exposed to risk assets at all, right?
No, I don't. And I think it's going to be one of the worst whipsaws that we're going to see, because but I am bullish now, very bullish. I mean, this is not the final, the end game, just not yet. We're seeing that because of the leading indicators, as I said, and we now start to see the slowdown in the coincident indicators. But again, also, if I had taken off in 2006, if you took off your investments into November 2006, when the signal was there from the leading side, well, then you would have missed a year worth of rise in the market. That's not the way to do it. The way to do it is to start looking at the coincident indicators, which now start to deteriorate, and the economy will then be running on life support from the central banks. And what the central banks are starting to do, if you look outside of the Fed, is that they have realized how bad this is. So if you look to the ECB, they are, I think, 9 or 10 cuts ahead of the Fed at this point. And the same goes from the People's Bank of China and so on. So they are already seeing this deterioration, and it's just a matter of when the Fed will see that. I think they're going to realize that now. I'm surprised to see how they could stand there on Wednesday and saying, "Oh, things are great, fine. We need to have a kind of a hawkish stance here." And then 2 days later, we see a significant deduction or revision of the non-farm payrolls going back to May. I don't know what they are looking into, but it's yeah. Anyway, so I think that we're looking at something that may develop in sort of the same manner of what we saw from the in 2007. I think a top in Q4 would be making a lot of sense, and a recession setting in end of this year could make a lot of sense. And then you will see people really realizing it sometimes in 26. It's always not the beginning of it. It's not like it comes out one day. I mean, nobody knew it was the top in October 2007.
No.
Before actually, things were starting to develop really badly in 2008. So it takes a while before things are happening. But with the current levels that we see, and also with the blow-off top that I think we could see, well, it could be a more spiky Eiffel Tower kind of move that we could see into the final top. And I think the Fed is going to come out, and I said it yesterday, and I think I'll just reiterate it here. I think you're going to see the Fed do a 50 basis point cut in September, and that is going to bring out the last rally, and that'll be it.
Yeah, I was just going to ask, is that sort of in your framework where the blow of top could be ignited because of a 50% basis point drop in September? Because in my point of view, so far I was like, okay, at some point this sort of bubble that's still going on now, also through July, but Bitcoin could actually be stopped by something like a cut in September. But in your view, it's more like, okay, this could ignite the final rally until everything unwinds, so to say, right? Okay.
The extension levels that I see have not been reached yet. I don't expect them to be reached by September. I actually think we're going to see sort of a decline. Not this what we're in right now. We saw last week. I think we're going to see a new all-time high coming now again. But then after that, I think we're going to see a decline. And you'll hear people coming out and saying things are bad. And maybe there'll be some bad numbers coming out, and people will be calling again. Now this is a double top, and now we're declining. At the point when the Fed comes out, boom, a 50 basis point cut, and we see the market going straight up. And then everybody will be pulled in and say, now the Fed has got our back. Yeah. This is actually one of the things I put on my chart. It says, now the Fed has got our back sentiment, because I'm expecting that to be the sentiment at the top. If it's not, I mean, I look forward to, writing things on X and saying, now I think we're close to the top, and then say, oh yeah, didn't you hear the Fed? I mean, that's the kind of sentiment you want, because then you know that, well, okay, now everybody's in. And
don't fight the Fed. Once the Fed is on your side, nothing can ever happen.
And actually, you should always fight the Fed if you just look to that. But that's another day.
Yeah, exactly. No, I just quickly want to turn to this altcoin vector framework. That you, I think, also at least help steer at a Swiss block. Digital assets. There's this sentence on your website as well. Digital assets aren't random. Pattern exists. Maybe if you could quickly go into what these patterns are they linked to the macro cycle, the business cycle that we just talked through, or is it like a macro within crypto that has its own patterns? Yeah, if you could elaborate there, that would be great as well.
Yeah, sure. So digital assets is a part of the game for now, and it's a thing where you've seen things going vertical when we get the alt season, and what I just described here with the macro situation is that the central banks are now starting to come in, and that is going to send a lot of liquidity into the system. People will think that things are all great, and that's because the central banks are now behind it, and you'll see that spiraling of risk going into the more and more risky assets, because the big ones have already made the big move. Bitcoin made its big move and so on. And right now we are seeing Ethereum starting to make the big move, and I think it's going to push quite a lot higher here on an Ethereum before, and then we'll see the rotation into others as well. So, and that we at Swissblog, we understand that there is a period for that. There is an alt season, but it's always difficult. Which asset at when? Which digital asset? Which coin? Which token? And this is where we developed a framework, which is the altcoin vector framework, where we simply there's an impulse coming. We can see that in the momentum and the way that it starts to move, and this is quite visible actually. And if there is put up a video today also that shows it also very clearly. And then you'll see that when that impulse comes, then that's when that particular coin starts to make its move. But we also would like to know also how far, and that's where we have the Elliott Wave extensions, which I then also back together with Paul Webborn, and we then see how we have an idea of how far this altcoin can move. So the thing is really when does it move? Oh, there's an impulse. Okay, let's analyze it. Let's see how far it can go. And that's mean that you can get a kind of a when, and also a potentially at least the idea of how far it can go. And that's our way of helping our clients, taking advantage of the old season and say, well, get in, get out. But I want to say here also, and that in the longer time frame, I would be very, very cautious of altcoins and even Bitcoin. I have to say that the crypto is I said it before, I say it again. Crypto is the very definition of this bubble, just like you had in the 2000s and you had before that. This is one of the key indicators that something is way off. That you have, Dogecoin with meme coins that are worthless, and be having these valuations of you don't know what. So this is just this is the sign that something, but it doesn't mean that you don't want to ride it for as long, and that's why we have the altcoin vector.
No, for sure. But is it true that maybe you see it similarly, that one of the patterns in crypto or in digital assets is really if Ethereum starts to make its move, it's like this prerequisite that we also need for a bigger altcoin season to unravel, because people have back and forth over the last 2 years always called for an altcoin season, and Ethereum was really underperforming all the assets even, and now for the first time we see Ethereum actually moving quite significantly. So to me, it almost feels like it's a like front-running indicator to what the Fed will do, as you said in September. I felt like it's probably the other way around. Once the Fed cuts, Ethereum will start moving, but maybe the market is already ahead again. Like Ethereum starts moving, signaling us that then the Fed might be doing its next move. But what I want to say is like Ethereum is really this important alt that needs to move. And that's exactly what we're seeing right now. I think even if you look at the models, we see this capital rotation going on from Bitcoin into ETH and then potentially later on into alts. So yeah, if you have any thoughts there, that would be great as well.
Yeah, sure. But that is exactly as you mentioned it there, and it works. And again, it just it shows us also the cycles that I try to illustrate or to talk about in terms of the bigger macro cycle. Things are working that way because people start to move in. There'll be liquidity coming out. It's not just about the Fed. We always forget that actually the ECB has a similar balance size like the Fed. The People's Bank of China, they also have a quite significant balance size. So it's not just about the Fed, but that's just what people can kind of talk about. But it's about the liquidity in the system, and that liquidity in the system is moving up when the business cycle is rolling over, and that's where all these coins come to life. And yeah, the first thing we need to see is that Bitcoin attracts all the money, all the capital, all the attention. And then people kind of say, well, we've seen it move so far. Maybe we should try something else out because the difference between Bitcoin and Ethereum is now so big. Let's do that. And then they move into that. And then all talks about Ethereum, why that's the best thing of the world. Then it moves up, and then you'll see something else coming out, and then you'll have it spreading out to the rest. And it's just about really how much capital has then been attracted into the whole system, into the whole crypto sphere. And then when the Fed then comes out, then people just say, oh, now look at it. This is really, and now the dollar is crashing also. And wow, let's just move in. So it's all human psychology is herd mentality by the end of it. And it's trying to maximize your own opportunities, wealth, whatever, is by moving into first that, then Ethereum, then the next one, and then, so on. That's why we move out the risk curve. And I think it's going to take us all the way out to the memes, and it's going to explode. And then, yeah, when everybody's partying, it's time to get to the lifeboats.
Yeah, exactly. On the Titanic, as you mentioned. Well, Henrik, that was great. Thanks a lot for sharing all these insights with us and for the time you've taken. Any last words, or where can people follow you if they also want to maybe follow the signals that you guys are putting out? Yeah, if you could just sum this up, this would be great.
Yeah, so the best thing is simply to go to @Henrik Zeberg on X and follow myself there, and also I will also be referring to Swissblock and the others there. You can go and so take a look at their account, the accounts there. Well, and then if there's anything, you please write back. Takeaway, I'll say just go look. Everybody who says that this time is different, just take a look, and it's really there. It's really, really there. It's just looking into the various macro factors, looking into what we've seen before, and just understand that history doesn't repeat it like something we've seen exactly before. It repeats, it rhymes, and it's and we have the similar kind of euphoria right now, and it's building even more the next few months as I see it. So take a good hard look.
Yeah, great. That's always good. Everyone should look for themselves. Well, thanks, Henrik, for doing this, and enjoy the rest of your day.
Yeah, likewise. Thank you very much.
Thank you. Bye.